Want to keep more of your hard-earned money without breaking the law? Here's the good news. The tax code is filled with legal ways to reduce your tax burden, and they're not just for the wealthy. Well, today on Financial Success Hub, we'll uncover strategies anyone can use to pay less in taxes. From maximizing deductions to strategic investments, we've got you covered. Ready to take control of your finances? Let's dive in. Step 1. Understand the tax system. The first step to avoiding unnecessary taxes is knowing how they work. Many people mistakenly believe earning more puts all their income in a higher tax bracket. This myth often leads to missed opportunities. Let's break it down. In the U.S., we use a progressive tax system. This means your income is taxed in chunks, not all at once. Imagine filling buckets. Each bucket represents a tax bracket with a different rate. For example, if you earn $60,000 in taxable income as a single filer in 2023, your income is spread across brackets. The first bucket, up to $11,000, is taxed at 10%. The next bucket is taxed at 12%, and only the remaining portion over $44,725 is taxed at 22%. The key takeaway? Not all your income is taxed at the highest rate. With this in mind, let's move on to strategies that help lower your taxable income. Step 2. Maximize tax-advantaged accounts. Want to shrink your taxable income? Tax-advantaged accounts are your best friend. Here's how they work. 401k plans. These employer-sponsored retirement accounts allow you to contribute pre-tax dollars. For 2024, you can invest up to $23,000. Not only do these contributions grow tax-free until retirement, but many employers also match a portion of what you contribute. Free money. Individual retirement accounts, IRAs. Even without a 401k, you can open a traditional IRA. Contribute up to $7,000 if you're under 50, or $8,000 if you're 50 or older. These contributions are tax-deferred, meaning you won't pay taxes on them until withdrawal. It's a great way to save for retirement while reducing your taxable income. Health savings accounts, HSAs. An HSA lets you contribute up to $4,150 tax-free in 2024 for medical expenses. This money grows tax-deferred, and any withdrawals used for qualified medical expenses are also tax-free. It's an excellent way to save for healthcare costs while minimizing taxes. Plus, after age 65, you can use the funds for non-medical expenses without penalties. Each of these accounts reduces your taxable income now while building wealth for the future. But what if you're self-employed or have a side hustle? That's where things get even more exciting. Step 3. Leverage self-employment tax benefits. Did you know the tax system favors business owners and freelancers? When you work a regular job, taxes are taken out of your paycheck automatically. But as a business owner, you get to deduct expenses before paying taxes. Here's how to use this to your advantage. Solo 401k, self-employed? You can contribute up to $23,000 to an employer-sponsored 401k and an additional $69,000 to a solo 401k. This allows for significant tax savings by deferring income taxes on both employee and employer contributions. It's a great option for freelancers or small business owners looking to maximize retirement savings and reduce taxable income. Home office deduction. If you use part of your home for business, you can deduct $5 per square foot, up to 300 square feet, from your taxable income. This means up to $1,500 in deductions annually. Ensure the space is used regularly and exclusively for business activities to qualify for this valuable tax break. Business expenses. Track all business-related expenses, including equipment, travel, meals, and even internet costs. As long as these expenses are necessary for your business, they can be deductible. Keeping detailed records ensures you maximize deductions and lower your taxable income. Be thorough to avoid missing any potential savings for your business. These strategies let you change the tax process from earn, pay taxes, then spend, to earn, spend, then pay taxes. Step 4. Invest strategically. Investing is not just about building wealth. It's a smart way to reduce your tax liability. Long-term capital gains are a prime example. If you hold an asset for more than a year before selling, your profits are taxed at a much lower rate, sometimes as low as 0%, depending on your income. You can also practice tax loss harvesting. By selling investments at a loss, you offset taxable gains, reducing your overall tax bill. Losses exceeding your gains can even offset up to $3,000 of your ordinary income each year, with the rest carrying forward to future years. Real estate investors can benefit too. Rental property expenses like mortgage interest, property taxes, and even depreciation are tax-deductible. Additionally, a 1031 exchange lets you reinvest profits from property sales without immediate tax consequences. Strategic investing ensures your money grows efficiently while minimizing taxes, keeping more of your wealth intact. Step 5. Utilize tax credits. Tax credits are one of the most effective ways to lower your tax bill. Unlike deductions, which reduce taxable income, credits directly reduce the amount of tax you owe. For instance, the child tax credit can provide up to $2,000 per qualifying child under 17. If you're pursuing higher education or improving your skills, consider the American Opportunity Tax Credit or the Lifetime Learning Credit. These can offset tuition and other educational expenses, making schooling more affordable. For homeowners, energy-efficient upgrades like solar panels or energy-saving appliances can earn you substantial energy tax credits. Not only do you reduce your tax bill, but you also save on utility costs. The key is to research and utilize all the credits available to you. They act as direct savings, ensuring you keep more of your income for the things that matter most. Step 6. Stay organized. Year-round. Effective tax planning starts with staying organized. The best way to avoid missed deductions or credits is to maintain accurate records throughout the year. Use budgeting apps or software to track income and expenses. Categorize transactions like business costs, medical bills, and charitable donations to simplify tax preparation. Keep a folder, digital or physical, for receipts and relevant documents. For example, if you donate to charity, ensure you keep records to claim the deduction later. Small purchases, such as office supplies, can add up to big savings if properly documented. Another critical step is reviewing your pay stubs and tax withholdings. Make sure you're not overpaying or underpaying taxes during the year. Adjust withholdings if necessary. Finally, work with a tax professional or CPA to review your finances annually. They can help you spot overlooked deductions and ensure compliance with ever-changing tax laws, saving you time and money. Step 7. The Warren Buffett Strategy. Warren Buffett famously pays a lower tax rate than many middle-class workers, thanks to strategies that anyone can adopt. One key move: prioritizing capital gains and dividends over regular income. Capital gains and qualified dividends are taxed at lower rates than ordinary income, making this approach highly efficient. Charitable giving is another cornerstone. Buffett donates appreciated assets instead of cash. This avoids capital gains taxes while earning a deduction for the full market value of the donation. It's a win-win for reducing taxes and supporting causes you care about. A less-known tactic is borrowing against investments. Instead of selling assets, wealthy individuals take low-interest loans secured by their portfolios. This provides liquidity without triggering a taxable event. While these strategies may seem advanced, they're accessible with proper planning. By adopting a mindset of tax efficiency, you can legally keep more of your wealth, just like the billionaires do. Taxes are a fact of life, but paying more than you have to isn't. By understanding the system and using legal strategies, you can significantly reduce your tax burden and keep more of your money where it belongs, in your hands. And the best time to implement tax-saving strategies is now. Whether it's opening a 401k, starting a side hustle, or learning about tax credits, every step you take puts more money back into your pocket. If you found these tips helpful, Don't forget to like this video and subscribe to the channel for more smart financial advice. Let's build wealth together, one step at a time.